You want to know what the Rockefellers and some of the wealthiest people have in common? They actually use life insurance as a wealth planning tool. So the markets will go up and down, right? That's a fact. If you looked at the track record of the S&P 500, it averages anywhere between 8 to 12% over the long term. But if you look year over year, you'll see where it actually fluctuates. It goes up and down. Now, you have a portfolio, regardless as to what the actual account is. You go in, you have a $500,000, it grows to 600,000. It could drop because of market correction. But you know what doesn't change? The life insurance death benefit. It won't. So if you're looking to leave behind a set amount of money or even more, you ultimately can create a policy that will grow based on the actual market. Or of course it could stay at one level. But ultimately it means that if something was to happen to you within a given time frame, they wouldn't have to worry about the fluctuations of the market because you're guaranteeing an actual amount that's going to go over. In fact, they won't have to sell an investment, sell a property, because they actually need money and the market is not doing too well in a given time frame. Now, besides that, you have the access to the cash value, right? Again, in a market downturn, you won't have to sell an actual investment that is underperforming and lose money. You don't have to recognize a loss. You ultimately can take a loan against your cash value or take a withdrawal. Either or. Like, the option is usually there depending on the structure of the policy, but the option is there to access the cash value, so you can use that as for a potential investment that you're seeing, real estate, whatever the case may be. But ultimately you have access to cash and not have to liquidate an asset that is currently underperforming or is going under correction.